Welcome to the Deep Dive. We're taking a close look today at the source material for one of the absolute giants, Alphabet Inc., the company behind Google, traded as GOGL for Class A shares and GOG for Class C.
Yeah, and this is a really significant one. Alphabet is, it's right at the heart of everything, technology and commerce these days. Our research really digs into its business model, its financial muscle, and critically, this core tension it's facing.
Which is?
Well, it's this battle between, the potential disruption from generative AI, something they helped create, and the constant drumbeat of global regulation. It's a fascinating push and pull.
And the timing couldn't be more interesting, right? The
Hmm.
sources point out this huge milestone, Alphabet hitting that $3 trillion market cap. That was back on September 15th, 2025.
Just incredible scale, puts them in a very, very small club, basically cements their status as one of the biggest economic forces we've ever seen.
So our mission today really is to get to the bottom of this for you. Is Alphabet's long run of dominance, this sort of fortress they've built on data and tech, still unshakable? Or is it maybe, just maybe, starting to look a bit vulnerable to this AI wave it unleashed?
That's the central question. And, maybe we should just give a hint of where the analysis lands up front.
Yeah, let's do that. The overall take from the sources is that this is an exceptional quality company, no doubt about that. And compared to its big tech peers, it actually looks reasonably valued.
But, and this is a big but, you have to accept this persistent, significant uncertainty around regulation. That's the asterisk, that regulatory landscape. It remains the single biggest shadow hanging over the company more than anything else.
Good point. And just for clarity, all the numbers we'll be discussing, the financials, closing prices, everything that's all based on the market close of October 17th, 2025.
Right. On that specific day, GOGL Class A shares closed at $253.30, and the GOG Class C shares were at $253.79. So part of our job is figuring out why the market puts that kind of price on this level of quality, especially with that regulatory overhang.
Okay, so how are we structuring this deep dive? The analysis is laid out in 7 chapters, and we're going to tackle them in 2 parts today.
First up, part 1, we'll look at the core, the engine, the drivers, and the fuel. That means digging into the business structure itself, how management thinks and acts, and the financials underpinning it all.
Then in part 2, we shift perspective. It's the view from outside, the risks, and the final judgment. So market sentiment, ownership structure, a full risk breakdown, and wrapping it all up with the final verdict. All right, let's dive into part 1, the engine, the drivers, and the fuel, starting right at the beginning with chapter 1, business understanding. And you really have to start with that big restructuring back in 2015, don't you?
Oh, absolutely. That move to create Alphabet wasn't just shuffling deck chairs, it was fundamental. The idea was to create more accountability, right? Sharpen the focus, protect the golden goose Google, while letting those other moonshots have space to succeed or, frankly, fail without dragging everything down.
And the foundation is still that multi-sided platform model.
Exactly. It feels free to us as users, doesn't it? Search, Maps, Gmail, YouTube, amazing services, zero upfront cost. But the trade, the real currency, is our data, our permission to let them gather immense amounts of really high-quality user information.
Which then fuels the ad engine.
Precisely. That data powers this incredibly profitable, highly targeted advertising machine. And that machine generates the cash that funds literally everything else within Alphabet. It's the financial heart.
You see this reflected in how they report their financials, broken down into 3 main pillars. First, the big one, the profit driver, Google services.
Yeah, this is the behemoth. It pulls in the vast majority of the revenue. Mostly advertising, of course, search ads, YouTube ads, ads on partner websites through the network. But it's important to see they are diversifying within this segment.
How so?
Well, the sources highlight these growing non-ad revenue streams. Things like YouTube Premium subscriptions, Google One cloud storage, and also hardware sales. The Pixel phones, Nest devices. Ads are still king, no question, but they're slowly building other high-margin, often recurring revenue lines right here in the core.
Okay, pillar number 2. The one everyone sees as the future growth engine, Google Cloud, GCP Workspace.
Right. This is their big play in the enterprise space, selling cloud infrastructure, platform services, those productivity tools under the Workspace brand. And the whole cloud market is just exploding, isn't it? Like a 20% compound annual growth rate projected.
It's a huge number.
Huge. And Google Cloud's mission isn't just about catching up to AWS and Azure on raw scale. It's about using their unique AI and machine learning know-how as a weapon, pushing things like AI as a service, catering to companies that use multiple clouds. That's their angle.
And the third pillar, the one that gets a lot of headlines, sometimes for the losses,
Yeah.
other bets.
Ah, yes, the famous moonshot factory. Waymo for self-driving cars, Verily in life sciences.
Hmm.
These are the really ambitious long-term projects. They operate at a pretty significant loss, and that's intentional.
Intentional.
Yeah, you have to think of it less like a normal business unit and more like a giant internal venture capital fund. It's speculative, high-risk, high-reward stuff, entirely paid for by the massive profits coming out of Google services.
What really jumps out, though, when you look at these three together is how they're connected. It's not just three silos. It's more like a loop, right? Strategic feedback loop.
That's the genius of the structure, I think. The huge profits from Google services, the mature ad business, act like this enormous non-dilutive funding source. It's internal VC, basically.
Meaning they don't have to sell more stock or take on debt to fund the future.
Exactly. And that cash gets plowed straight into massive capital expenditures, CapEx. They budgeted a record $85 billion for 2025. And the vast majority of that is going into building out specialized cloud infrastructure, data centers packed with AI hardware.
Which then helps the cloud division develop better AI.
Precisely. This heavy investment lets Google Cloud build, train, and deploy state-of-the-art AI, like their Gemini models. But here's the loop. That cutting-edge AI then gets fed back into the core Google services business.
How does that work?
Well, Gemini makes search better, makes ad targeting more precise, maybe even enables new kinds of conversational ads. This makes the core ad business even more effective, which generates even more cash flow.
Which then funds more CapEx for cloud and AI development.
You got it. It's a powerful, self-reinforcing cycle that's very hard for competitors to replicate.
We've got the revenue breakdown here for fiscal years 2022 through 2024. It really shows that hierarchy, but also the shift happening.
Yeah, search is still the dominant force, no question, consistently around 56–57% of total revenue across those 3 years. But look at cloud's growth. It jumped from just over 9% of total revenue in 2022 to 12.35% by 2024.
That's a significant move.
It really is, especially when you consider the scale. The total revenue base grew from about $282 billion to over $350 billion in that same period. So cloud isn't just growing, it's taking a bigger piece of a rapidly expanding pie. It shows a reacceleration of growth, which is, frankly, incredible at this size.
And the industry context makes this even more compelling. Digital advertising, a $650 billion market growing at maybe 9% a year through 2034.
And cloud computing growing even faster, projected at that blistering 20% CAGR. Alphabet is sitting right at the intersection, using AI to optimize its position in both. But holding that position requires a serious competitive advantage and moat.
The sources definitely paint a picture of deep, durable barriers. In advertising, it's almost a duopoly with Meta, but you have serious competition from Amazon, Microsoft's AI-powered Bing, obviously TikTok. So where's the real defensive strength?
It comes down to 4 main things, really. First, just sheer brand strength and the network effects in search. More users mean more data, which makes search better, attracting more users. You know the drill.
The flywheel.
The flywheel, exactly. Second, economies of scale. Their massive global data centers give them huge cost advantages. But maybe even more important are their custom-designed TPUs, tensor processing units.
Right, they design their own AI chips. Why is that such a big deal compared to just buying the best GPUs from, say, NVIDIA?
Because it's about vertical integration in the most critical area, AI hardware. Competitors buying off-the-shelf chips are subject to supply constraints, pricing battles, you name it. Alphabet designs TPUs specifically optimized for their own AI models, like Gemini and the stuff from DeepMind.
So better performance, maybe lower cost for their specific needs.
Potentially, yes. Better speed, efficiency, cost per calculation for the tasks they care about most, and that massive $39.5 billion they poured into R&D in 2023. A huge chunk of that supports this custom silicon effort. Very few companies on Earth can afford to do that.
Okay, scale, brand, custom hardware. What's the fourth advantage?
The truly unique assets. Decades worth of user data. It's non-replicable, and it's absolutely essential for training the most advanced AI models. Combine that with the world-class AI talent they've accumulated, especially through acquiring DeepMind. It's a formidable barrier.
So with all that strength, that deep moat, where's the main vulnerability? If the fortress is so strong, what's the biggest threat?
It keeps coming back to the same thing, antitrust scrutiny. Relentless global pressure. The legal battles, like the ones with the U.S. Department of Justice, they target the very practices that secure Google's dominance in default search engine deals, bundling services, and so on.
They avoided having Chrome broken off recently, though.
They did, which was a win for them.
Yeah.
But the fundamental risk hasn't gone away. The threat that regulators somewhere in the world will force significant changes to their business model. That remains the single biggest danger. It could potentially unravel that strategic feedback loop we talked about.
Okay, that sets the stage for the business itself. Let's pivot now to the people in charge. Chapter 2, management evaluation. Who's steering this giant ship through these choppy waters?
It takes a certain kind of leadership, navigating both the AI race and the regulatory minefield simultaneously. Extremely steady hands are needed.
Starting at the top with Sundar Pichai, the CEO, known for being calm, empathetic, and the one who really pivoted the company towards being AI first.
Right, and his current challenge is immense, really. He's got to lead the charge in deploying generative AI, which, as we said, could disrupt their core business, while also defending the company on multiple legal and regulatory fronts globally.
That requires a lot of political skill, not just technical know-how.
Absolutely. Part of his strategy seems to be positioning Alphabet's massive AI investments not just as good for the company, but as essential for national technological leadership. It's a defense mechanism trying to align corporate goals with geopolitical ones.
Then there's Ruth Porat, the president and chief investment officer. She came from Morgan Stanley back in 2015 and gets a lot of credit for bringing financial discipline, especially to those other bets.
Her role is absolutely critical, especially after her promotion in 2023. That move put her in charge of the entire capital allocation strategy. Think about that. M&A decisions, internal investments, managing the venture arms like GV and Capital G, everything flows through her.
So in this capital-intensive AI arms race we keep mentioning, she holds the purse strings.
She does. And that determines who gets funded, how much, and ultimately shapes the company's strategic direction in a very tangible way.
Does that create a tension, though? If she's the voice of financial discipline, coming from Wall Street, does that potentially clash with the old Google moonshot culture? You know, the culture that encourages big, risky bets.
That's a really insightful question, and it's a constant balancing act. The criticism you sometimes hear is exactly that. Maybe too much discipline could stifle truly revolutionary ideas in favor of predictable growth in areas like cloud or just maximizing shareholder returns now.
But the evidence suggests otherwise.
Well, look at that massive $85 billion CapEx budget for 2025. That signals they're not afraid to spend big. The sources suggest her discipline isn't about not spending, but about being very focused on where it goes, primarily AI infrastructure supporting cloud and search. It's more about optimizing the big bets, maybe, than eliminating risk entirely.
Okay. But back to risk, the regulatory risk. It seems directly linked to the criticism about their data collection practices, privacy, and so on.
It absolutely is. Those ethical concerns, the privacy debates, even scrutiny over things like alleged tax avoidance strategies. These aren't just bad PR. They provide the ammunition, the political and legal justification for governments to step in and potentially force changes.
So the better they get at collecting data for ads, the bigger the regulatory target on their back.
That's the inherent tension, yeah. It's a difficult tightrope to walk.
Let's look at how they're deploying capital now, the capital allocation strategy. That $85 billion CapEx figure for 2025 is a huge statement of confidence.
It's enormous, and again, overwhelmingly focused on building out the specialized AI infrastructure data centers, custom chips needed to meet the surging demand for cloud and AI services. They're clearly spending aggressively to solidify their lead.
And beyond building internally, they're still using M&A strategically. We know the history, YouTube, Android, DeepMind were transformational deals. What about more recently?
The big one highlighted is the $32 billion deal announced to acquire Wiz, the cybersecurity firm.
How does that fit in?
It's a direct shot in the arm for Google Cloud. Cybersecurity is like the top concern for any large company thinking about moving sensitive workloads to the cloud. Buying Wiz instantly boosts GCP's security credentials, making it a much more compelling option for those big enterprise clients, maybe peeling some away from AWS or Azure.
Makes sense. Now, let's talk about shareholder returns. They've always done massive buybacks like $59 billion in 2022, over $61 billion in 2023, and now a new $70 billion program authorized. But the really big news was the dividend.
Huge news. Initiating their first ever quarterly dividend in 2024. That signals a real shift, a new stage of maturity for the company. It started at $0.20 per share per quarter, quickly bumped up to $0.21.
What message does that send?
It sends a powerful message of confidence. Basically, we generate so much free cash flow that we can fully fund the incredibly expensive AI arms race and still return billions consistently to our shareholders. It also opens the door to a whole new class of investors, those income-focused funds that might have ignored Alphabet before.
And does the data show this capital is being deployed effectively? What about return on invested capital?
Yeah.
ROIC.
That's the key metric for judging management's effectiveness, right? And Alphabet's ROIC has been trending strongly upwards. The trailing 12-month figure hit a very robust 28.2%.
Wow.
Yeah, that tells you they're not just throwing money around, they're investing it in ways that generate extremely high returns on that capital. It's a sign of real quality, deep competitive advantages, and strong operational management.
Okay, we've covered the strategy, the leadership. Let's get into the numbers themselves in Chapter 3, Financial Analysis. This really confirms the sheer size and stability we've been talking about.
The scale and momentum are just hard to wrap your head around sometimes. A market cap hovering around $3.06 trillion as of mid-October 2025, trailing 12-month revenue hitting $371.4 billion. I mean, these are nation-state level numbers.
And importantly, after that little wobble everyone saw during the broader economic slowdown, the source data shows growth snapped back, reaccelerating to nearly 14% in 2024.
Which is phenomenal. Growing at double-digit percentages on a base that large is incredibly difficult. Few companies on Earth can do that.
And that growth translates into exceptional profitability. The margins are really something else.
They really are. Looking at the trailing 12 months again, gross margin at 58.9%, operating margin at 32.7%, and net margin at 31.1%. Truly elite levels.
And we should probably add that context again about the consolidated numbers versus the core business.
Yes, absolutely crucial. Those margins, impressive as they are actually dragged down a bit by the planned losses in the other bets segment. If you could isolate just the core Google services business, the ad engine, its operating margins are likely north of 40%.
Which speaks to incredible pricing power.
It does, near monopoly-type profitability. And the consistency is also remarkable. Look at diluted earnings per share. It went from $2.96 back in 2020 up to $8.04 in 2024. Just a powerful, consistent upward trend.
And underpinning all this is what the sources call a financial fortress, balance sheet.
Yeah, fortress is a good word for it. They rely very, very little on debt. The debt-to-equity ratio, a tiny 0.065. That's just 6.5%. They have far more cash than debt.
So massive flexibility.
Complete flexibility. And liquidity is also very strong, even with that huge CapEx spend. The current ratio is 1:90, meaning they have $1.90 in current assets for every dollar of current liabilities. About $166 billion versus $87 billion. This balance sheet lets them play offense in the AI race without needing to issue more stock or take on restrictive debt.
All right, the big question then. Valuation analysis. We know the quality is exceptional, the balance sheet is a fortress. Is the stock actually cheap, expensive, or about right?
Well, let's start with a relative look. The trailing 12-month price-to-earnings, or PE ratio, as of that October 17th date, was sitting around 27.0.
How does that stack up against the other tech giants?
It looks pretty favorable, actually. You often see Apple and Microsoft trading at much higher PE multiples, maybe in the 38x to 39x range around that time. So on the surface, that 27 PE for Alphabet suggests it might be relatively undervalued. Or, more likely, it reflects that significant discount the market is applying because of the regulatory risk we keep talking about. The quality might warrant a higher multiple, but the risk holds it back.
But we should probably talk about that earnings number itself, the E and PE, shouldn't we? Specifically, stock-based compensation, SBC.
Yes, very important nuance for tech stocks especially. Alphabet pays out a lot in stock to its employees and executives, billions and billions every year. Standard accounting, GAAP earnings, treats this as a non-cash expense.
Which inflates the reported earnings number a bit.
You could say that. Many serious investors prefer to think of SBC as a real cash cost, because it either dilutes existing shareholders or represents cash the company could have used differently. If you adjust the earnings downward to account for SBC as a cash expense,
then the PE ratio goes up.
Exactly. That 27.0 GAAP PE might actually look more like 30x, maybe even 32x on a cash-adjusted basis. So the takeaway for you listening is, while the headline PE seems cheaper than peers, once you account for stock compensation, it's probably more in line with its high quality, just still reflecting that regulatory discount.
And what about trying to find an intrinsic valuation, say, using a discounted cash flow or DCF model?
Those models are always tricky, very sensitive to your assumptions about growth rates, discount rates, etc. But the sources suggest that if you plug in reasonable inputs for a company like Alphabet,
Like what?
well, maybe projecting growth in the low double digits, say 10, 12% for the next few years, then tapering off to a long-term perpetual growth rate of 2 or 3%, and using a discount rate appropriate for a stable blue chip, maybe 8 to 10%.
What kind of value do you get?
Often, the intrinsic value estimates you get from that kind of model tend to bracket the actual market price around $253. So it suggests the market isn't being irrational. The current price seems to reflect the quality, the growth prospects, but also factors in that stock compensation and the significant uncertainties. It's not screamingly cheap, but maybe not wildly overvalued either.
Okay, let's shift gears now to part 2, the view from outside, the risks, and the final judgment. We kick this off with Chapter 4, market sentiment. How is Wall Street feeling about Alphabet right now?
Overwhelmingly positive, actually. You look at the analyst consensus based on somewhere between 38 and 57 analysts covering the stock, and it comes out as a strong buy. The narrative around AI leadership and financial strength is really resonating.
And the price targets, do they reflect that optimism?
They do, but with a really interesting spread. The average 12-month price target range is somewhere between $240.85 and $258.81. So pretty much right where the stock was trading in mid-October.
Okay, so analysts think it's fairly valued on average.
On average, yes. But look at the range. The high-end target is way up at $340. The low-end target is down at $185.
Wow, that's a huge difference, almost $155 between the most bullish and most bearish analyst.
Exactly. And what that huge spread tells you is that the disagreement isn't really about the quality of Alphabet's business today. Everyone agrees it's excellent. The disagreement is about the probability and the potential impact of those big external risks, regulation, and AI disruption.
So if you're bullish, you think they navigate those risks and head towards $340. If you're bearish, you think the risk materialize and could fall back towards $185.
That's basically the framework the range suggests, yeah.
What about the media tone? Mostly positive recently.
Generally, yes. Lots of coverage on the strong earnings reports, the growth in Google Cloud, that favorable outcome in the DOJ case regarding Chrome. But the negative stories are always lurking, focusing on what remedies might still come from regulators, geopolitical risks, things like that.
And the technical market indicators,
Yeah.
do they support the bullish view?
They do seem to. For instance, short interest, the percentage of shares borrowed and sold short by investors betting the price will fall is very low for GOGL, around 1.02%.
What does that low number really mean for listeners?
It suggests that sophisticated investors, the big institutional players, aren't making significant bets against the company based on near-term operational problems or financial collapse. The bears aren't shorting it because they think earnings will miss next quarter.
So the bear case is more structural long-term.
Exactly. The bear case is about those big external events, a major regulatory ruling, or a fundamental shift caused by AI that could change the whole business model. And those are much harder, riskier narratives to trade via short selling. Low short interest signals confidence in the near-term stability.
And technically, the price trend itself looks strong.
Yeah, as of mid-October, the stock price around $253 was comfortably above both its 50-day moving average, which was about $246.10, and its 200-day moving average around $246.38. That confirms a solid long-term uptrend was in place.
Okay, next chapter, Chapter 5, ownership structure.
Who
Actually owns this $3 trillion company? And crucially, who controls it?
Well, starting with who owns the stock available to trade, the institutional giants dominate. Somewhere between 60% and 78% of the publicly traded shares are held by institutions, mostly the big passive index fund managers.
The usual names, I assume.
The usual suspects, yeah. The top three, according to the sources, are the Vanguard Group holding about 7.7%, BlackRock with around 6.5%, and State Street Corporation at 3.5%. This gives the stock a very stable, long-term institutional foundation.
But ownership isn't the same as control here, is it? Let's talk about the elephant in the room. Insider control, the governance issue.
Right. This is absolutely fundamental for anyone investing in Alphabet. Because of the unique share structure, the co-founders, Larry Page and Sergey Brin, along with some other early insiders, hold special Class B shares. These shares carry super voting rights, meaning they collectively retain majority voting control over the entire company, even though they own a minority of the economic value. Public shareholders, the ones holding the Class A, GOGL, and Class C, GOG, shares you buy on the market, essentially have no say in major corporate decisions or electing the board. They are disenfranchised from a voting perspective.
That's pretty stark for a $3 trillion company. They're basically trusting the founders entirely. Does the market price that in? Is that part of the reason for the lower PE compared to Apple or Microsoft?
It's highly likely, yes. This dual-class structure with founder control is generally disliked by governance experts and many large institutional investors. It's plausible, even probable, that a governance discount is embedded in that PE ratio of 27.
So if they ever collapsed it into a single share class with one vote per share?
The stock price would likely jump, yes. The valuation multiple would probably expand almost immediately, reflecting the removal of that governance risk. But there's no indication that's going to happen anytime soon.
What about insider transactions? Are the insiders buying or selling?
The pattern highlighted is mostly selling. Over the past year, covered by the sources, insiders sold more than 10 million shares.
Should we be worried about that?
Not necessarily on its own. A lot of insider selling is pre-planned, part of scheduled programs for diversification or tax purposes, especially for founders with huge concentrated positions. But what's perhaps more telling is the lack of significant open market buying by insiders.
Meaning?
It subtly suggests that while management is clearly confident about the business prospects, they don't necessarily see the stock as deeply undervalued at the current price of $253. They seem comfortable selling shares at these levels, which kind of reinforces the idea that the market price is roughly in line with their view of fair value, incorporating those risks.
All right, this brings us to a critical part of the analysis, Chapter 6, Risk Assessment. We're looking at the classic SWOT analysis, strengths, weaknesses, opportunities, and threats, to really frame the forces shaping Alphabet's future.
Yeah, this structure helps lay everything out clearly. The strengths are pretty obvious by now, right? Dominant market position, near monopoly in search, huge platforms like Android and YouTube.
Technological leadership, too.
Absolutely. Clear leadership in AI, investments in quantum computing, all protected by something like 67,000 active patents, plus that fortress balance sheet we discussed, massive free cash flow, and a very sticky ecosystem, Gmail, Drive, etc., high switching costs for users.
Okay, but even giants have weaknesses. What's the main one?
The big one remains that revenue concentration. Despite all the growth in cloud and the other bets, the company is still overwhelmingly reliant on advertising. It accounts for roughly 80% of total income.
And the weakness there is?
Exposure to the economic cycle. If there's a global recession or even just a slowdown in ad spending, Alphabet feels it much more acutely than, say, Microsoft with its diversified software and cloud revenue, or Amazon with its e-commerce and AWS mix. It makes them more cyclical than some peers.
And the other major weakness is simply being a target.
Yeah, that dominance makes them a constant regulatory target. The risk isn't just fines, it's the potential for forced changes to their fundamental business practices. That's the core vulnerability. We should also probably mention their historical failures in social media, Google Plus being the famous example. They missed a huge segment now dominated by Meta and TikTok.
Fair point. Okay, let's flip to the positive side. Opportunities. Where's the big upside potential?
Number one has to be AI integration, using Gemini, DeepMind, all that tech to make search even smarter, create new ad formats, but also, crucially, to generate entirely new revenue streams through advanced AI services sold via Google Cloud. That's a massive opportunity.
And just continuing to grab cloud market share?
Definitely. The cloud market is still growing incredibly fast. By differentiating GCP with superior AI and data analytics tools, they have a huge runway to keep gaining share from AWS and Azure, especially with large enterprise customers who value that AI edge.
And the long-term opportunity.
Monetization of other bets. Imagine if Waymo actually cracks autonomous driving at scale and becomes a massive, profitable business. Or if Verily makes breakthroughs in healthcare. That would fundamentally change the investment case and diversify the company away from just ads. It's a long shot, maybe, but the potential is enormous.
Okay, finally, the threats. What keeps management up at night? We know regulation is one. What else?
The other huge one is technological. Generative AI disruption. The sources frame this as the first truly credible technological challenge to Google's search dominance in maybe 2 decades.
Explain how that disruption works. What's the mechanism?
Think about how search has traditionally worked. You type a query, you get a list of blue links, you click one, go to a website, and Google sells ads against those clicks and on those websites. Generative AI, Things like chatbots or Google's own search generative experience, SGE, changes that flow.
Oh.
Instead of a list of links, you often get a single synthesized answer directly on the results page. The AI writes a summary for you.
And the threat is that users don't click the links anymore.
Exactly. If users get their answer right there, they might not click through to the underlying websites or the traditional ads placed around the links. This could potentially cannibalize Google's most profitable ad inventory, those high-value search ads. Plus, running these complex AI queries is more expensive computationally, and there's less space on the page for the old style of ads. It's a fundamental shift in the user journey and the economics.
A major technological threat, then, alongside the regulatory action threat, which could force them to change that ad model anyway.
Right. Those are the two big existential threats. But the analysis also points to a more immediate, perhaps underappreciated threat: geopolitical factors, specifically the impact of the 2025 U.S. imposed tariffs.
How do tariffs hit a digital company like Alphabet?
In a couple of ways. First, directly. They're spending $85 billion on CapEx, building data centers full of servers and specialized hardware. Tariffs increase the cost of those components, hitting their bottom line directly via higher spending.
Okay, higher costs. What's the second impact?
It's a second-order effect on revenue. The sources highlight that these tariffs hurt the business models of major e-commerce advertisers based in the Asia-Pacific region. Think companies like Temu or Shein. When their profit margins get squeezed by tariffs, they pull back on their advertising budgets.
And a lot of that ad budget goes to Google platforms.
Precisely. So U.S. tariff policy ends up creating a direct revenue headwind for Google because some of its biggest international advertisers have less money to spend. It shows how interconnected everything is.
Which brings us neatly to the end. Chapter 7. Conclusion. Let's synthesize all this analysis. Can we summarize the core bull versus bear case?
I think we can. The bull case rests on incredibly strong pillars. That near unassailable dominance in search and digital ads, the massive free cash flow funding, world-leading AI research and development, the rapid growth and potential of Google Cloud, that bulletproof balance sheet, the increasing shareholder returns via buybacks and dividends, and arguably a valuation that's reasonable, at least on a GAAP basis, compared to peers.
Solid bull case. What about the bear case?
The bear case, interestingly, is almost entirely focused on those external factors we just discussed. It really boils down to two massive risks. First, the ongoing global antitrust regulation that threatens to force fundamental, potentially damaging changes to their core advertising business model. Second, the existential threat that generative AI truly disrupts search, changing user behavior and undermining the economics of their ad gateway.
So quality and execution versus external disruption and regulation.
That's the core tension, yes.
And let's just quickly revisit the valuation summary recap. Trading at that PE of 27.0, intrinsic value models suggest it's roughly fairly priced.
Yeah, while the models can bracket the current price, it feels like the market is applying that discount for the regulatory and governance overhang. That's likely what keeps the PE from reaching the higher levels of Apple or Microsoft. The price seems to reflect both the quality and the risks.
So, wrapping it all up, the concluding outlook for someone considering this as a long-term investment.
The analysis suggests Alphabet is undeniably a company of exceptional quality. It's a leader in AI, arguably the most important technology shift happening right now. But investing here means you absolutely must be comfortable with significant, persistent, systemic uncertainty.
Uncertainty specifically around.
Specifically around the regulatory landscape. You're essentially betting that management can navigate the AI disruption successfully, and that regulators ultimately won't be able to dismantle the core profit engine that funds everything. If you can accept that considerable regulatory risk, then the underlying quality of the business and its current valuation look quite compelling.
That really is the crux of it, isn't it? That trade-off between quality and regulatory risk. Now, as we finish up, we always like to leave listeners with a final provocative thought, something to chew on that builds on our discussion.
Okay, how about this? We spent a lot of time talking about how the bear case hinges on advertising concentration and the associated regulatory risk. But think about the other bets for a moment. What happens if one of those moonshots, like Waymo, actually hits escape velocity?
Meaning it becomes a huge, profitable business in its own right.
Exactly. If Waymo matures into a major self-sustaining revenue generator, maybe dominating autonomous logistics or transport, how does that change the narrative? Suddenly, Alphabet isn't just an advertising monopoly that regulators want to break up.
It becomes something else. An infrastructure company.
Yeah.
A logistics platform.
Right. It diversifies the revenue stream significantly, potentially lessening the dependence on ads and easing that regulatory pressure over the long term. It could fundamentally transform the risk profile and maybe neutralize a core part of the current bear pace, something to think about for the very long term.
A fascinating possibility. It really reframes the company's potential future.
Definitely.
Okay, before we sign off, just a quick reminder. If you found this deep dive valuable, please like and subscribe to Stock Analytics AI. For just €4.99 a month, you get access to our full playlist that's 500 deep dive videos covering every single stock in the S&P 500.
And next up, exclusively for our members, we're tackling the NASDAQ 100. Plus, members can request specific stock deep dives. Just drop the ticker symbol in the comments section and we'll get on it for you.
And finally, the important disclaimer.
Yes. Please remember, this analysis was generated by an AI system. It's intended for educational purposes only and should absolutely not be considered financial advice. Always do your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Thank you for joining us for the deep dive. We'll see you next time.